let's just kick things off with a pretty brutal truth. You could have the absolute best stock tip in the world. I mean, a real guaranteed winner, and you could still end up losing a ton of money. Actually, most people do, and it's because we've all been taught to focus on completely the wrong thing. You know the drill. We're always hunting for the perfect stock, the perfect entry point, the perfect system. But what if I told you that the system itself is the least important part of your success? So, get this. When you really dig into what makes traders successful, the actual system they use, the buy and sell signals, that only accounts for about 10% of their success. That's it, just a tiny little sliver. So if the system is barely even a factor, what in the world makes up the other 90%? All right, first step, we need to totally tear apart this 10% myth. This really dangerous idea that finding a perfect system is all you'll ever need. Okay, now this is where it gets really fascinating. This is the actual breakdown of what makes or breaks you in trading. Look at this chart. That system, the thing everyone obsesses over, it's just 10%. Money management, basically how you handle your bets, is 3 times more important at 30%. And the biggest piece of the pie by far, psychology, a whopping 60%. That means your own mind is the biggest reason you'll either win or lose. And this quote just hits the nail on the head, doesn't it? It perfectly explains the trap we all fall into. We spend all our time and energy looking for some magical, foolproof system. Because, let's be honest, it feels like a shortcut. We want someone to just hand us the answer. But this whole search for an external holy grail makes us completely ignore the two things that actually move the needle: managing our money, and more importantly, managing our own minds. So this leads us straight into the single biggest problem that pretty much every trader faces: the trader's emotional trap. At our core, we're basically herd animals. It's just wired into our DNA. And when it comes to the market, this instinct makes us do exactly the wrong thing at exactly the wrong time. We see prices shooting up, we feel that FOMO, the fear of missing out, and bam, we buy. Then we see prices dropping, we panic, and we sell. It's like the perfect recipe for buying high and selling low, every single time. This emotional curve just captures that journey perfectly. It all starts with, hey, the price is rising, I'll just watch for now. But then it keeps going, and you think, okay, I gotta buy before I miss this whole trend. So you buy in. At the very peak, it's pure euphoria. I'm a genius, I'm gonna double my stake. And then the correction hits. The first thought is denial, right? No, this can't be true. As it drops even further, panic kicks in, leading to, oh man, before I lose everything, I better sell right now. And of course, the most painful part comes right after you've sold at the bottom. You see the price start to creep back up and think, I knew it was going to keep going up. So how in the world do you protect yourself from this emotional roller coaster? Well, you need a system that works despite your emotions. What you need is a financial airbag. And that airbag has a name: money management. And it's a beautifully simple concept. It has nothing to do with what to buy or when to buy. It's a disciplined technique that just answers one single critical question before you even think about placing a trade. How much? How much of my capital am I actually willing to risk on this one idea? And this slide really shows you the fundamental shift in thinking you need to make. The old way is all about finding that holy grail system, always asking, what should I buy? And trying to control the market, which is, impossible. The new focus, the money management focus, is all about calculating your risk, asking how much should I risk, and controlling the only thing you actually can: your own losses. Okay, this is where things get really practical. Let's actually look at the simple math that takes all the emotion and all the guesswork out of sizing your positions. Okay, so here's the crucial 4-step process. First, you know your total capital. Let's just say it's 100,000 euros. Step 2, you decide on the absolute maximum you are willing to lose on any single trade. A really common rule is 1%, so that's 1,000 euros. Step 3, your own analysis tells you where your idea is proven wrong. That's your stop loss. Let's say it's 20% below your entry price. And now for step 4, the magic part. You just divide your max risk in euros by your stop loss percentage. So 1,000 divided by 20% gives you your position size: 5,000 euros. See? The math tells you how much to bet, not your gut feeling. And here is the real-world impact. Look at that top line. That's a trade based on a gut feeling. You're super excited about a stock, so you throw in 20,000 euros. The stock drops 20% right to your stop-loss level, and you lose 4,000 euros. That's a 4% hit to your entire portfolio from one trade. Ouch. Now look at the bottom line. With money management, your position size was calculated to be just 5,000 euros. The stock still drops 20%, but your loss is capped at exactly 1,000 euros. That 1% risk you decided on beforehand. It's the same stock, the same loss, but a completely different and much less painful outcome for your portfolio. And this brings us to the ultimate takeaway here. The goal isn't to try and master the crazy, unpredictable whims of the market. The goal is to master the one thing you have absolute power over, your own risk. Now, it's important to know that these principles apply to literally everyone, but the specific tools you use might change depending on your portfolio size. For smaller portfolios, maybe under 50,000 euros, buying a bunch of individual stocks can get really expensive with fees, so using diversified funds is usually way more efficient. As you grow past 100 grand, you get more flexibility to mix in individual stocks with funds and ETFs. And for the really large portfolios, you can build out a really robust, diversified portfolio of maybe 20 to 30 individual stocks, which gives you maximum control. The core principle of controlling your risk is always the same. It's just the tools that adapt as you scale up. So look, if there's just one thing you take away from all this, please let it be this. This is the core philosophy. Stop trying to predict the future. Start protecting your capital. And that leaves us with one final question for you to really think about. Take a hard look at your own strategy right now. Do you even know the answer to this? How much of your capital are you actually risking on each individual trade? If your answer is, I don't know, or, well, it kind of depends on how I feel that day, then that is your first and most important step toward becoming a more disciplined and most likely a more successful investor.